Welcome to the deep dive. Today we're cutting through the noise to explore the disciplined, rational, and really business-oriented investment philosophy of Warren Buffett. We're using Robert Hagstrom's fantastic book, The Warren Buffett Way, as our guide, our mission.
To pull out practical insights you can actually use for your own financial decisions, showing that, amazing results aren't just for the Wall Street pros.
Exactly. We're going beyond just the what. We want to get into the why behind his incredible consistency. It's about understanding the principles, not just memorizing stock picks, giving you real blueprint.
Okay, so let's dive right in. Where does this all start for Buffett?
It's rooted in value investing, isn't it? An idea from Benjamin Graham.
That's right. Graham's original idea, it was often about finding statistically cheap stocks, buying $1 for 50 cents, essentially, looking for companies trading below liquidation value, things like that, very quantitative. But Buffett, he took that foundation and, evolved it significantly. He realized a great business, even if it wasn't, dirt cheap, could be way more powerful over the long run. So his focus shifted. It became about buying great businesses at fair prices and holding them long term. That really changed the game.
Right, from bargain hunting to business analysis. And that leads straight to his famous line, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." It sounds simple, but what's the practical difference? What's the trap in chasing that fair company at a wonderful price?
Well, the trap is at a wonderful price for just a fair company. It's often temporary, a market blip. You might get a quick gain maybe, but a merely fair company often lacks that inherent strength, that competitive edge.
Right.
So it probably won't compound value dramatically over decades. It might bounce, sure, but it's not likely to be a wealth creator.
Whereas the wonderful company,
the wonderful company, even at a fair price, has qualities that let it grow its earnings, its intrinsic value, year after year. That's where you get the real power of long-term compounding. It's about the business's ability to grow value, not just the initial discount.
so it really flips the focus away from short-term deals towards long-term compounding.
That takes serious patience, though, right? Especially when everyone's buzzing about the next hot thing.
Oh, absolutely. A totally different kind of discipline is needed.
Now, Hagstrom's book breaks Buffett's approach down really well into 4 main categories of tenets, like a checklist for you, the listener. Let's start with the business tenets. What about this idea of investing only in businesses you understand? The circle of competence. How hard is it to actually stick to that?
The circle of competence is crucial. It's not just about what you know, it's about being honest about what you don't know. Think about Buffett avoiding early tech giants, not because they were bad, but because he felt he couldn't reliably predict their futures.
That discipline, staying in your lane, it's your best defense against chasing shiny objects you don't grasp and potentially making huge mistakes. He wants businesses with a consistent track record, predictable earnings. He wants to really know the business, reduces the risk of nasty surprises.
Okay, building on that understanding, this is where it gets really interesting for me. Durable competitive advantages. His economic moats. What are they? And why are they so critical?
An economic moat is exactly what it sounds like. It's protection, something defending the business from competitors. Think of a strong brand like Coke, or a unique product, maybe a cost advantage, network effects, something that keeps rivals at bay.
So without one?
Without a moat, profits get competed away easily. But with one, a company can sustain high returns, protect its market share, sometimes for decades. It's what keeps a wonderful company wonderful.
Okay, so a great business with a moat. But what about the people running it? That brings us to the management tenets. What's Buffett looking for in leadership?
This is more qualitative, but just as vital. He wants honest, competent managers. And crucially, managers who are shareholder-friendly.
How do you even spot that?
You watch their actions, not just their words. Do they operate with integrity? Do they act in the long-term interest of all owners? Or are they just focused on their own bonuses, building empires?
And it's fascinating how he looks at how they handle the company's money, right? Reinvesting profits wisely versus, say, chasing short-term stock bumps.
Exactly. He wants excellent capital allocators, people who treat the company's profit like it's their own savings. Do they reinvest smartly in the business? Do they buy back shares when it makes sense? Or do they just make splashy, often value-destroying acquisitions? He calls that the diarrhea of the wallet. He's very wary of that.
Right. So beyond the business quality and the management, the numbers still matter a lot. Let's unpack the financial tenets. What specific metrics does he prioritize? It's not just growth, is it?
Definitely not just growth. He really digs into key indicators. Return on equity, ROE, is a big one. It shows how effectively a company uses shareholder money to generate profit. He often looks for businesses consistently hitting, say, 15%, 20% or more.
Okay. What else?
He looks hard at profit margins. Are they stable, sustainable, or are they easily squeezed by competition? And critically, debt levels. Too much debt is a huge red flag. Leverage magnifies risk both ways.
And cash flow.
Yes. Strong, predictable cash flow is key. That's the real fuel for a business, maybe more so than reported earnings sometimes. And high returns on invested capital show the company isn't just growing, it's growing smartly, compounding value efficiently.
So understanding the underlying financial engine, not just the surface numbers, which leads nicely to the value tenets. Understanding true worth, the idea of intrinsic value. How tricky is that to figure out? And how does the margin of safety fit in?
Intrinsic value. Well, it's the real underlying worth of the company.
Yeah.
What it's genuinely worth based on its future cash generation potential, like how a private buyer would assess it. The challenge, it involves forecasting the future, which is, inherently uncertain. You have to make reasonable assumptions.
Right.
But once Buffett estimates that value, then comes the margin of safety. This is absolutely crucial. It means only buying when the market price is significantly below that estimated intrinsic value, maybe 20%, 30%, sometimes more.
And that gap is the protection.
Exactly. It's your cushion. Protection against errors in your own calculation or just unforeseen bad stuff happening. It limits your downside risk.
That really reframes things, doesn't it? Thinking like an owner buying a whole business, not just gambling on a stock price flicker.
Yeah.
You wouldn't overpay for a house. Why overpay for a piece of a company?
Precisely. It's about the fundamentals.
Okay, these 4 pillars, business, management, financial, value, give us a solid framework. But knowing them is one thing. Applying them consistently, especially when markets get wild, that needs a certain mindset. Let's talk about how Buffett actually puts this into practice and the psychology involved.
Well, one thing that stands out in his practice is concentration over diversification. This kind of goes against conventional wisdom, right?
But yeah, most advice is diversify widely.
But Buffett prefers holding fewer companies, maybe 10 to 15 sometimes, that he understands deeply and has high conviction in. His thinking is, if you find truly great businesses, why dilute your returns by spreading your money too thinly across mediocre ones you barely know?
Which makes sense if you have that conviction. And it links to his long-term focus, right? These aren't quick flips.
Not at all. He often holds investments for decades, literally decades, letting that compound growth work its magic, letting those moats protect and grow the business value over time. It requires immense patience.
Patience and discipline. You mentioned he waits for the fat pitch. What does that mean in practice? Just sitting on cash sometimes.
Yes, exactly that. Waiting for that perfect opportunity where a great business meets all his criteria and is available at a significant discount with that margin of safety. He's not compelled to constantly be buying. He can wait, sometimes for years, for the right setup. That's incredibly hard for most people to do.
And that waiting, that resistance to chasing trends, highlights his independence of thought. He just doesn't follow the herd or Wall Street fads. But how can an individual investor cultivate that? How do you tune out all the noise, the 24/7 news cycle, the market chatter?
It really comes down to focusing on your own research, your own analysis of the business fundamentals, having the confidence in your own homework, rather than getting swayed by, what the talking heads on TV are shouting about. You have to trust your process and ignore the noise. Buffett basically teaches you to be your own best advisor.
It almost sounds like the hardest part is managing your own emotions, resisting fear when markets drop, resisting greed when things are soaring.
That's a huge part of it. It's the psychology of investing. Buffett emphasizes emotional stability. When everyone else is panicking and selling low, you need to stay rational. If your analysis still holds up, maybe that's even a buying opportunity.
Avoiding that herd mentality.
Absolutely. If a stock is suddenly massively popular, maybe ask why. Is it truly undervalued or just caught up in hype? You need confidence in your work, even if the market disagrees for a while. And always, always view stocks as owning a piece of a real business, not just a flickering quote on a screen.
Being an owner, not a speculator. That's the key shift. Let's make this concrete. The book uses examples, right? How do cases like Coca-Cola or GEICO show these principles in action?
Great examples. Coca-Cola, bought for its incredible brand that's a massive economic moat, its pricing power, and its global growth potential. Predictable, wonderful business. The Washington Post. He bought it when it was way undervalued by the market, but had a strong local newspaper franchise. He saw the intrinsic value far exceeded the stock price. Margin safety right there. And GEICO, an insurance business he understood inside out. Simple, scalable model, huge cost advantage, another durable moat, consistently high returns on capital.
It really shows how he applies the same core principles across very different industries, doesn't it? He's not a tech investor or a consumer goods investor. He's a quality investor.
Exactly. And the key lessons for you, the listener, distilled from all this. First, stick within your circle of competence. Seriously, don't stray. Second, buy businesses. Think like an owner, not just a stock ticker. Third, look relentlessly for those durable competitive advantages, the moats. Fourth, be patient. Let compounding do the heavy lifting over the long term.
And the people matter too.
Right. Fifth, value management, integrity, and skill just as much as the financials. And finally, sixth, always, always demand that margin of safety before you buy. It's your safety net.
That's a really powerful framework. It underscores the whole message. Buffett's success isn't some secret formula or market timing magic. It's disciplined, rational, business-focused thinking.
And it absolutely shows that ordinary investors can achieve extraordinary results. You don't need to be on Wall Street. Focus on value. Focus on quality businesses. Be patient. Think long term. You really can build significant wealth this way. Think like an owner.
So here's the thought to leave you with. Pick one business you feel you truly understand. Maybe one you interact with every day. Now, try looking at it through Buffett's lens. What's its moat like? How's the management? What might its intrinsic value be, roughly? Is the current price offering a margin of safety? Challenge yourself to see investing less as a game and more as, well, an act of careful analysis and potential ownership. You might just surprise yourself.